Good afternoon, everyone, and it's nice to see a few familiar faces out there with which to start yet another conference, and we'll see what we can get out of this out of today's session. I'd like to pick up on some of the broader themes that both Chris and Alex have addressed, and really consider them within a specific geographical context, one that we predict is probably likely to have less excitement in it pricing-wise than perhaps some others. So, to give it a sort of a bit of a metaphor, if you liken the uncertainty swirling around the market to a hurricane, as we tend to do at this time of year, seems to be on the top of everyone's agenda, the eye of that storm, we believe, may have settled right here over Europe. The quiet, the calm, the not much happening. That makes trying to provide a pricing outlook for the forthcoming January renewal a dubious prospect at the best of times, particularly challenging this year. So weighing the factors that we expect to influence pricing movement in the remainder of the year, we expect prices to be flat to down in Europe and indeed across the wider EMEA region at this January renewal. So let me explain why. Reinsurers have faced a challenging environment this year. We'll start with sort of the picking up on Chris's factors that may suggest pricing should go up. So as I say, reinsurers have faced a challenging environment this year. You can see in this chart, which tracks the capital levels of the Carpenter Global Reinsurance Composite Index, that the heavy losses sustained during the first half of 2011 led to a decline in the reinsurance sector's capital position. And as per usual, excess capital builds up during soft markets to be eroded, leading to harder markets. And we appear to be at an interesting point in the line as discussed by Chris. Before the hurricane season even began, as I say, we estimated that 2011 Nat Cat losses to the reinsurance sector were more than double reinsurers' catastrophe budgets. Now, we appear to have dodged a bullet recently with Irene, but clearly any further cat activity during the remainder of this year could have a critical impact on reinsurer capital and the market position for the January renewals. Sorry, my page is in the right order. So, if we look at these, we think, are the four key influencing factors. We've spoken about losses. So secondly, we'll turn to cat model changes. Now, these have contributed to this year's volatility and uncertainty, with major revisions by RMS to its European windstorm and US hurricane models, and AIR have also recently updated its pan-European earthquake model in July. These model changes significantly altered risk perceptions, leading to a wide-ranging impact on loss estimates and a significant burden on companies struggling to incorporate them. As you would expect, these models and their influence on the market have come under the scrutiny of our analytical team, and Bill Kennedy will talk about this research in a few minutes. And we believe the research and the work we put into this is critical in helping our clients to optimize their approach to these changes. Third point, Solvency II. Solvency II, we talk about a lot. The initiative and its administrative and capital burdens continue to present challenges and could affect pricing if the market's burden is more, or conceivably, though unlikely, less, if it could be more than anticipated. The focus among companies preparing for Solvency II is shifting from capital models to risk management, corporate governance and disclosure requirements, all of which potentially entail increased administrative costs. So, do we expect this impact to become clearer? Probably at some stage in the future. That's assuming the hotly contested open implementation issues ever get finally resolved. Fourth point, the Eurozone fiscal crisis. Now, this so far has managed to remain contained, but has created a deep undercurrent of uncertainty this year. A worsening crisis, needless to say, can affect business and pricing in any number of ways, everything from direct solvency pressure on insurers as asset values fall or structural defaults occur, to increases in counterparty credit risk, to potential refinancing difficulty for short maturity holdings, portfolio holdings. So, those are factors that should and could ideally contribute to a potential for an increased pricing environment. But despite this, we equally see a number of factors that could subdue upward price movement at the 1st of January. and these are they. So first and foremost, we believe a material degree of industry overcapitalization continues to exist. To put some numbers on this, we estimate the global reinsurance sector's dedicated capital position to be around about $10 billion above historical averages, given risks assumed. Although this excess this position has fallen from about $20 billion at the start of 2011, the underlying quality and liquidity of the overall dedicated reinsurance capital remains extraordinarily strong. Secondly, clearly we note this year to date, in stark contrast to all other regions, Europe has seen very little catastrophe loss activity. Despite rate increases elsewhere throughout the world, this year, through mid-year renewals and coming up to renewal, this end-year renewal, rates have been flat to down across the European region on a risk-adjusted basis. So in the absence of any significant losses to this region throughout the remainder of the year, we would continue to expect subdued and appropriate pricing pressures in the region. Thirdly, model changes. Whilst causing a lot of intellectual and practical disruption, these have really been very specifically focused on certain types of coverage, essentially US hurricanes and European windstorm. If your exposure to these was limited, so was the impact on your business. Moreover, we're also hopeful that the industry will start to see these models and the model changes in a proper context. That is, as useful, supplemental tools, but not market-shaking events in and of themselves. So fourthly, back to Solvency II, which never seems to go away. For all the hand-wringing around this subject and its final form and implementation timeframe, preparations at most companies appear to be reasonably well underway and under control. We expect plenty more debate over this issue as the implementation date approaches, whenever that might exactly be, but we do think it is unlikely that we'll see surprises big enough to fundamentally affect the pricing environment. So, in conclusion, what does all this add up to? Well, despite all the challenges and variables that have set the current market adrift, we believe there is adequate capacity if it is approached sensibly and carefully. We believe that barring late-year catastrophes or sustained upward revisions of early 2011 loss estimates, these factors will keep aggregate risk-adjusted rates in Europe flat to slightly down at the 2012 renewal. And clearly, we will be seeking just that for our clients. Thank you.